Howdy, partners. Warren Buffett's holdings were recently released, and there were several large buys. The big news is that they bought Google, but that's not what we're going to talk about today. We're going to talk about a stock that he put $12 billion into last quarter, and it's not Google, it's a Dividend Aristocrat. So the stock I'm talking about is Chubb Limited, which is a global insurance and reinsurance organization. And Berkshire Hathaway has owned Chubb since 2023, but they haven't added to the stock since the middle of last year. That is until the third quarter of this year when they added $12 billion. So let's talk about this company. Let's talk about what they do, go through the business model and the investment case, and see why Berkshire maybe bought this company. So they're one of the largest publicly traded property and casualty insurance companies, which of course, Buffett and Berkshire have a deep understanding of. So the interesting thing with these guys is they have a really specialized, diverse, and global portfolio. They sell insurance, accident and health products, life insurance, reinsurance. They're in 54 countries and territories. And they're really built on two primary engines. So one is their underwriting discipline, and second is their investment income. And their investment income is very conservative. So most of it is in fixed maturity securities. It's very stable. But the really interesting thing with Chubb is that their property and casualty underwriting profit tends to be very high. They do a really good job at their underwriting. So let's take a look at kind of how their revenue is split. And you can see that there's three main sources. It's property and casualty income, life income, and then their investment income. So 40% of their net premiums earned come from North America's commercial property and casualty insurance. Overseas insurance, they get about 27%. Life insurance is 13%. Personal property and casualty is 12%. And then the agricultural insurance is 5%. And then their global reinsurance is small. It's about 3% of their net earnings. So geographically, very heavy in North America. If we take North America and Canada, that's 63%. Asia, we've got 18%. Europe's about 13%. And Latin America is about 6%. Their products range a broad kind of span. So they serve things like large multinational corporations that need complex property and casualty and risk management solutions, middle market and small businesses through their commercial property and casualty, a lot of affluent and high net worth individuals that need coverage for complex assets. Think like high value cars, boats, airplanes. That's kind of the personal property and casualty. Of course, the reinsurance companies and the farmers that are insuring things like crops or farms and ranches. So one of the interesting things about Chubb is that they have that global footprint in 54 countries. So they can write locally admitted policies for things like multinational corporations. Let's look at their management. So Evan Greenberg has been a director of Chubb since 2002, and he's been the CEO since 2004. Before he was with Chubb, he was president and COO of AIG. And he's really the person that gets a lot of the credit for the company's really disciplined underwriting culture. Chubb has a combined ratio consistently below 100%. They're one of the lower ones in the insurance space. And basically what that means is that they are always profitable. A lot of insurance companies, if that combined ratio is over 100%, that means the company is losing money on policies they write. Chubb does not do that. Another nice thing to see is that he's got a fair amount of money in Chubb shares, more than 166 million. Peter Enns is the CFO. He's been there since July of 2021. He's got 30 years of finance and investment banking experience. He's been at HSBC, Goldman Sachs, and he owns about $11 million in Chubb shares. Again, nice to see. And here's that combined ratio I was talking about. So you can see in the 80s is very good. So 88, 87, 86 recently. The management team does a really good job at making sure that the company stays profitable. I mentioned their Dividend Aristocrat, so let's look at dividend growth. They've grown their dividend for 32 years in a row, and it tends to grow over the last 5 years. It's been about 4.2% every year that we've gotten a dividend raise. So over 10 years there, 3.6. So you can see they're starting to kind of accelerate the rate of dividend growth. Of course, we need to know about the market that they operate in. So the property and casualty insurance market is what I would call pretty attractive. It's got a few benefits. So one is inflationary pricing. So rising inflation is making insurers raise premiums to cover higher expected claims cost, which means that there's strong pricing power in a lot of Chubb's lines of business. The other thing that's going on is that the global middle class is growing. So geographic expansion, really in Asia and Latin America, means that there's more middle income, middle class types of populations. So they need more life and personal and casualty insurance. The market's big; it's huge. You can see here globally, 2023 it was 1.8 trillion. By 2032, it's expected to be 3 trillion. So that's a 6% CAGR through 2032. Let's talk about some of the main risks. So catastrophe and climate risk, obviously when you're insuring property, you have exposure to losses from natural disasters like hurricanes, earthquakes, wildfires. And we've seen in recent years that some of these seem to be increasing both in frequency and intensity from things like climate change and just weather shifts. There's definitely competition and pricing risk here. So competitors are seeking market share, new capital is coming into the market. And the market is currently what's called softening, which means kind of prices are coming down. Competitors are writing lower priced policies. And some of these lower price policies are going to result in losses and that combined ratio going over 100% for some of the other companies. Chubb is just not going to play that game. So they may see some decline potentially in market share or revenue just based on competitors doing silly things. This is kind of a cyclical thing that happens in the insurance industry. We go from hard markets to soft markets. When those companies start losing money on policies, they either raise prices or go out of business. And last, we have some financial and economic sensitivity. So obviously their investment portfolio is sensitive to interest rate changes. It's heavily in those fixed income types of securities. And then some of its insurance products, like the trade credit financial lines of insurance, are vulnerable to economic downturns. They can lead to increased claims and bigger losses. Look at the balance sheet. Chubb's is very healthy. Their debt to equity ratio is very, very low. We can also look at their credit ratings by, the major credit rating agencies. They're all excellent. So Chubb has a very strong balance sheet. Let's look at their capital allocation. So that dividend payment, the payout ratio tends to be very low. So that's conservative. That's nice to see from an insurance company. Also means that they have some room there for dividend growth. This is also a company that tends to return some cash to shareholders through buybacks. You can see here their diluted shares outstanding has been kind of consistently decreasing since about 2017. And they do generate attractive returns on equity for their shareholders. It's a little bit variable, but overall, this is pretty attractive. So let's look at kind of how this company's grown. You can see here pretty steady growth in revenue and EPS. A little bit of volatility there, but again, with an insurance company, some years are going to be really good, some years a little worse, depending on how many claims you have to pay out, that sort of thing. Another thing, management raised guidance last quarter, including their medium-term target. So the CEO, Evan Greenberg, said they think 70 to 80% of their business presents attractive growth opportunities. Looking forward, they think the way that they've been performing in the past is going to continue. They're looking at double-digit EPS growth and their ROE increasing to 14% over the medium term. So that's excellent. Right now, the current yield for a dividend is 1.3%. And again, that payout ratio is nice and low, meaning that they should be able to keep growing those dividends into the future. So now we need to look at valuation. And I usually do this in 3 different ways. So one, quickly, I like to look at the dividend yield versus the history. You can see here it's about 1.3. The average is about 1.8. So a lower dividend yield indicates a higher stock price. So based on this, it does not look like Chubb is overly cheap. We also usually do an earnings growth model, which takes into account our EPS growth, the dividend yield we're getting, and then a change in a multiple. So here's kind of the assumptions I used for Chubb. And that gives us an 8.2% return per year. Last, I do a reverse dividend discount model. So basically what we're looking for here is what growth rate is the market pricing into the dividend um, for a targeted return. So I use 10%. Again, here's my assumptions. And when we do the calculations, we see that the market's pricing in 8.6% growth in Chubb's dividend, and that 5-year dividend per share CAGR is only at 4.2. So again, it looks like the market is maybe pricing in a little bit more growth than we're going to get. So overall, I would say Chubb is a great insurance company with really good management. They allocate capital well. The balance sheet is strong, but that dividend growth rate isn't as high as I would like to see for something with a 1.3% dividend. And overall, the current valuation looks kind of high to me. So this is not a company that I would be buying, but I can definitely see why Berkshire did. This is a world-class underwriter. They maintain that low combined ratio. Again, this management is strong, and it's got that global reach that really gives Chubb a competitive advantage compared to a lot of the other insurance companies out there. So this is definitely a great, stable business that I would consider owning at the right price. Right now, Berkshire's got that massive cash pile, and there's not that many things they can invest in. This is something that's nice and stable. It lets them put some money to work in something that's not treasuries. So my suspicion, that's why they invested in this, not because it's a screaming deal, but because it's something stable that's going to give them higher returns than something like T-bills that they've been buying. So let me know in the comments what you think. Is this a company that you're going to invest in? Let me know if you like this style video. Thanks for watching, and I'll see you in the next one.